Hello everyone, I am Dr. Ross DePinto. I am one of your D366 course instructors. In this session, we are going to conduct a lesson review of Section 3, Lesson 4.1, which is Earnings-Based Valuation Models. For this lesson, the only required readings are going to be found in the actual OEX platform. There is no additional reading from the e-text required. In this session, we're going to present an overview of earnings-based valuation practices. We will review three of the most commonly used earnings-based valuation ratios: EBIT divided by EV, EBITDA divided by EV, and the price-earnings ratio, and discuss their interpretation and limitations. We'll then review the EBIT divided by EV ratio calculation process and present a worked example. We will do the same with the EBITDA divided by EV ratio and present a worked example. And then we're going to review the price earnings ratio calculation process and also present a worked example for you. Something to note is that as you're going through this session, it's a good idea to have your calculator and scrap paper available as you walk through the calculations presented here in the session. Make sure your calculator is set to 4 decimal places as we walk through these examples. So the first thing we'll discuss is a brief overview of earnings-based valuation models. They're the most commonly used valuation models because of their simplicity and their relevance. They're based on the assumption that shareholders value profitability. And the three most commonly used earnings-based valuation models are the EBIT to EV, which is the enterprise value ratio, the EBITDA, which is earnings before interest, taxes, depreciation, and amortization, to enterprise value ratio. And then finally, the price earnings ratio, which is the price per share on a stock divided by its earnings per share. Now, these ratios are going to also require some important formulas. The first is the actual formula for the enterprise valuation, which is going to be our equity market capitalization, which is the value of the firm's stock in the market, plus total debt minus cash and cash equivalents. The next is the equity market capitalization for the firm, which is going to be the number of outstanding shares of stock there are times its market price per share. So these are some common formulas that we will be using throughout this session. The first form of valuation we will talk about is EBIT-based valuation, earnings before interest and taxes. So the EBIT to enterprise value ratio compares earnings before interest and taxes to the enterprise value. And this is useful for comparing firms with different debt and tax structures. Many firms use a lot of debt, some use a little bit. And so this allows us to have parity in that regard. The other thing it takes away is the impact of tax structures. A primary example of this is that some firms are located in states where there are state income taxes. Some states don't have income taxes. So this eliminates the tax burden as part of the variability in the results. And just a general rule of thumb is the higher the value is for these ratios, the better indicator these firms are as an investment. The next form of valuation ratio we have is the EBITDA-based valuation. And so EBITDA is earnings before interest, taxes, depreciation, and amortization, and divided by our enterprise value. So this ratio is going to exclude the impact of depreciation and amortization, so it focuses mainly on the cash the firm generates. Because remember, depreciation and amortization, they are real costs of doing business. They represent the wear, tear, and usage of our fixed assets, but they don't represent cash outlays. So if we include those in our valuation, it can understate the firm's cash position. So these forms of valuation treat all of the cash that the firm generates. And so it's really a good way of comparing capital intensive firms, because a lot of capital intensive firms are going to have a large amount of fixed assets on their balance sheet and therefore a lot of depreciation and amortization expenses, especially when there's different accounting policies. So you could take two firms that buy the same $1 million asset, and they may have different policies in place as far as what is the useful life of the asset. What depreciation schedule are we going to use, either a straight line or an accelerated? And then different firms may place different salvage values on the same asset depending on how heavily they're going to use it. So this form of comparison takes that out of the evaluation. But the limitation here is because we're taking out the impact of these fixed assets, it also ignores our capital expenditures, because keep in mind, depreciation expenses start to reduce as our assets age out and need replacement. So this can kind of be a constraint on using these types of ratios. Now, the last thing we'll talk about is the price earnings ratio, and you are going to have some insights when you are using this ratio. So our price earnings ratio is the share price, the price per share, also abbreviated as PPS, divided by our earnings per share, which is EPS. And this is widely used across industries. And so lower price earnings ratios in the range of 12 to 15 often indicate that the firms are undervalued and have growth potential. And then high PE ratios suggest that there's limited upside, meaning there's really not a whole room for the investor to cash in on something that other folks aren't aware of. It's kind of a commonly known entity that is everybody wants to invest in. And so they're at full valuation. They're typically very highly priced stocks. So interpreting these ratios is important. So let's talk about the EBIT to EV ratio. So this represents the enterprise's return on operating profit. Okay, so it talks about how efficiently the company generates profit from its total invested capital, regardless of how that capital was acquired, either through debt or equity, because we're not including depreciation and amortization expenses. So the higher the value of this ratio, it indicates better operational performance and also can indicate an undervalued company. So the next ratio, our EBITDA to EV ratio. So this measures the return on enterprise value from operating cash flow before non-cash expenses. Because remember, our depreciation and amortization are non-cash expenses. So EBITDA is often used as a proxy for cash flow from operations. And it indicates how strongly the organization is generating revenue and profits from its regular activities. So this is useful for comparing companies that have different depreciation and amortization policies, as we just discussed. Different companies use different depreciation schedules, salvage values for the same assets as you compare them. So this strips out that variability. And again, higher values of this ratio indicates strong cash flow generation and also potential undervaluation. So in general, we look at these ratios as yield ratios, meaning how much return we are getting on an investment. It's the same thing we look at as far as earnings yield in equity valuation in our stocks. So the way that investors interpret these ratios is how much return they are getting per dollar of enterprise value. And this is helpful in identifying efficient operations, companies we might want to acquire to bring into our fold, and also as investors to look for undervalued stock where we can generate both dividends and capital gains in our investment portfolio. Now, there are some limitations to these ratios, but also some adjustments we can make. So these earnings-based models look at historical data, and they may not be good indicators of future performance. An example I'd like you to consider is when we first hit the COVID lockdown. So analysts were using data based on a normal economy, normal economic conditions, normal economic activity. Well, at the beginning of 2020, that's kind of went all out the window when the COVID lockdown occurred, because firms that should have been generating a lot of revenue and profits, a lot of them weren't. You look at the hospitality industry, the restaurant industry, all of those were very constrained in how much revenue and profit they can generate. So any type of market pricing or evaluation that was done based on historical data was pretty much inapplicable once you got to COVID. So to make some corrections for these types of challenges you can have with using historical data, a lot of times we use something called forward price earnings projections. So we look at the firm's projected earnings to account for anything that might be coming down the pipeline as far as strategic changes they want to make or innovations they're going to implement to improve their operational efficiency. And so this helps investors look at the future potential and steer them away from past results. That's especially true now because many firms have recovered from the issues that occurred during COVID. Now, if you look at their financial performance during those few years, they're going to be dramatically different from what they experienced prior to COVID and what they're experiencing after COVID. So these are just some modifications that can be made to these models to help drive more valid values and make better decisions. So let's talk about the EBIT to enterprise value ratio first. So we will walk through the calculation process, and I'm going to pop up my calculator here to show you a worked example in a minute, but let's just walk through the details first. So the EBIT to EV ratio requires two values. The first is EBIT, earnings before interest and taxes, or also known as operating income. And this is going to come from the income statement. If EBIT is not directly stated, we're going to need to calculate it from income statement data. So depending on the information presented to you, there's two approaches, either the top-down approach or the bottom-up approach. So the top-down approach means we start with revenue at the top of the income statement and we will be working our way down through the expense structure. So if we're working top-down and we have to start with revenue, it would be revenue minus cost of goods sold, minus operating expenses, and then minus depreciation and amortization. Or if you just have EBITDA and depreciation and amortization available, you can just subtract your depreciation from EBITDA and you will get EBIT. There are situations, however, where you're just going to get abbreviated income statement information. They might not give you all the top line information. So you sometimes have to take what's called the bottom-up approach, meaning you're starting down at the bottom of the income statement where net income lies, and then you have to work your way back up by adding things back to net income. So if we have to take that approach, we'll typically use EBIT equals net income plus taxes plus interest expenses plus interest income. Now, if the information is available, you can also use earnings before taxes plus interest expenses and interest income. So that's the first primary value, EBIT. The second is our enterprise value. So that has to be calculated from balance sheet and market valuation information. If the market capitalization value is not directly stated, we have to calculate it. So our general formula for enterprise valuation is the market capitalization plus the total debt minus the cash and cash equivalents. Okay, and our market capitalization, if it's not provided, needs to be derived, and we usually find the number of shares is going to be presented and the market value per share. And so our market cap value is going to be number of shares times the market value per share. Once we have those two foundational items, we can then apply a three-step process to calculate the EBIT to enterprise value ratio. So the first step is going to be to calculate the enterprise value, calculate EBIT if it's not available, and then calculate the EBIT to EV ratio. So let's go through a worked example. So in this case, we have Orion Software Limited reports market capitalization of $620 million and also reports the following financial information. And so we have our list of balance sheet and income statement accounts that they've provided. And the question is, what is the EBIT to EV ratio of the company? So let's start with step one, which is finding the enterprise value. And we know that the formula is the market capitalization plus total debt minus cash and cash equivalents. So let me pop the calculator up here. So we have to identify the relevant information. Now, we're given the market capitalization of $620 million, so we can enter that directly in our calculator. Okay. The next thing we need is the total debt. And it says our total debt is $95 million, so we're going to add that. Okay, the last thing we need to do is subtract out all cash and cash equivalents because those can be used to pay down any outstanding debt. So we're going to subtract that $55 million. And we get a total enterprise value of $660 million. Okay, step two of the process. We have to find our earnings before interest and taxes. So let's take a look at the details that are provided. In this case, we don't have a lot of the top level information from our income statement, but we have the bottom line information. So we'll be taking the bottom up approach by starting with net income and adding back our interest expenses and our taxes. So let's clear the calculator and let's start working through that calculation. So net income is $43 million. We're going to add back the interest on the loans, which is $7 million. And then we're going to add back our taxes, which is our $6 million. And we get a total of $56 million. So now that we have our two primary values, we can now calculate the ratio. And our formula is our EBIT divided by enterprise value. So let's grab the calculator again and perform that calculation. So we take our $56 million, which is our EBIT divided by the enterprise value of $660 million. And that gives us 0.0848, which is 8.48%. So the way we interpret this is our investors get an 8.48 EBIT return on every dollar of enterprise value. So they're earning 8.48 cents on each dollar of enterprise value. Okay, so the next valuation we'll use is the EBITDA divided by enterprise value ratio. And again, there's two primary values we're going to need, EBITDA and enterprise value. And so we need to take the same approach to finding our EBITDA information from the income statement. If it's not directly stated, we have to calculate it from income statement data. There are the two approaches, depending on the information you receive. If you're doing the top-down approach, well, then EBITDA is going to be revenue minus cost of goods sold minus operating expenses. Or you can start at gross margin minus operating expenses. If you have to take the bottom-up approach, EBITDA is going to be equal to your net income plus taxes plus interest expense plus interest income plus our depreciation and amortization. Or if EBIT is already provided, you can just take EBIT and add our depreciation and amortization. And then that second value is the enterprise value. It's calculated the same as we did in our prior calculation. Market capitalization plus total debt minus cash and cash equivalents. And the three-step process is very similar to the last calculation we did for the EBIT to EV ratio. So we're going to first calculate our enterprise value, then we're going to calculate EBITDA, then we're going to calculate the EBITDA to EV ratio. So let's take a look at this example. Our company has 10 million shares of outstanding stock with a market value of $40 per share. The company's cash and cash equivalents are worth $35 million and the total debt is worth $80 million. A snippet of the company's income statement is given below, and we have our financial information presented here. These are values coming from the income statement. Okay, and it says, what is the EBIT to EV ratio of this company? So let's walk through. So the first step here is we have to calculate the enterprise value. Now, it's not given to us directly. Our market cap is not presented here, but we do have the two variables needed to calculate the enterprise value. We have how many shares are outstanding and what the price per share is on the market. So the first thing we're going to do is calculate our market cap. So we're going to say 10 million, and everything is stated here in millions, so we can just type in 10. Everything's at common scale. So 10 times $40 a share, that's going to give us a market cap value of 400 million. Okay, so the next thing we're going to do is plug in the rest of the values. So our total debt, we're going to, excuse me, add that, and that is 80 million, so plus 80 million. Then the last thing we have to do is subtract out our cash and cash equivalents, so minus our 35 million. And that gives us an enterprise value of 445 million. Okay, so the next step is to calculate EBITDA. Now, we already have operating income. Operating income is EBIT. So all we have to do here is add back our depreciation and amortization expenses. So let's work through that calculation. So we have our operating income is 37 million. Okay, we're going to add back our depreciation of 6 million. And then we're going to add back our amortization of 7 million. And that gives us a total of 50 million for our EBITDA value. And then the last step of this process, oops, I'm sorry, my mouse is being very temperamental here. Okay, so the last step is to calculate the EBITDA to EV ratio. And so we're going to take our 50 million of EBITDA, divide it by our enterprise value of 445 million. And that's going to give us a ratio value of 0.1124 or 11.24%. So it's telling us that investors are going to get an 11.24% EBITDA return on each dollar of enterprise value, or 11.24 cents on the dollar. So another application for these ratios is what's called multiples. And so what we simply do is we can take these ratios and express them as a multiple. So if you take a look here, all we've done is, instead of taking EBIT or EBITDA and divide it by enterprise value, we reverse them. The enterprise value becomes the numerator, and then EBIT or EBITDA becomes the denominator. So if we divide our enterprise value by EBIT, it tells us how much investors are paying for each dollar of operating profit. If we have our enterprise value to EBITDA ratio or multiplier, it tells us how much investors are paying for each dollar of pre-depreciation and amortization cash flow. So when would we use this? Okay, so the EV to EBIT multiplier is useful for comparing companies with similar capital structures and depreciation policies. As we stated earlier on the ratios, this makes for a more uniform comparison when we know that firms have different policies in place for how they conduct depreciation and amortization. Then the EV to EBITDA multiplier is useful for comparing companies across industries because some are more capital intensive than others. And so it removes the effect of having our non-cash expenses associated with the depreciation and amortization of assets. Now, both of these multipliers are used when we value firms when we're doing mergers and acquisitions, and also for investment screening to see if a company is potentially overvalued or undervalued. So lower multiples indicate that the firm is going to be undervalued or more efficient. Higher multiples may suggest that there's growth expectations or that the firm may be overvalued at that point. Okay, so we have a couple of worked examples of these two multiples. So the first thing we have here is some financial information from firm A. We've got the market capitalization value, the value of total debt, the cash and cash equivalents. We've got our operating income, which is EBIT, and then we have EBITDA, where we're adding back depreciation and amortization. So let's work through each one of these calculations. So first is the enterprise value. So we're going to take our market cap of 400 million. We're going to add our debt of 80 million. And then we're going to subtract out all of our cash and cash equivalents, which is 35. And we get an enterprise value of 445 million. So the first thing we'll calculate is the enterprise value to EBIT multiple. So we are given our EBIT value of 37 million. So we're simply going to divide that enterprise value by the 37 million. And we get a multiplier value of 12.03 rounded. Okay. The next thing we'll do is we'll calculate the enterprise value to EBITDA multiple. So again, we're going to take our enterprise value of 445 million, divide it by our EBITDA, which is 50 million. Remember, we're adding back depreciation and amortization, so that figure is going to be higher. And that gives us a value of 8.9. So the conclusions we can draw, again, this tells us how much investors are paying for every dollar of operating profit. So if we're using our EBIT multiplier, it's telling us that investors are paying $12.03 for every dollar of operating profit the firm generates. And it's telling us that they're paying $8.90 for every dollar of pre-depreciation and amortization cash flow the firm generates. And this will help investors and potential acquisition targets benchmark these values against other firms or industry averages. So the next ratio we're going to talk about here is the price earnings ratio, where we're comparing the stock's price to its earnings. So we're going to divide the price per share by the earnings per share. It's one of the most widely used earnings-based valuation tools. And it's really useful for comparing companies within the same industry because they're typically going to have very similar capital structures. They're going to have very similar asset structures. So this ratio is going to tell us how much investors are going to be willing to pay for a dollar of earnings. When we interpret this price earnings ratio, there's three value ranges we typically screen things in. So, a price earnings ratio of 10 to 15 is what we consider low, and it may indicate that the firm is undervalued or has low growth expectations. If it's undervalued, it represents a potential investment opportunity. The average range is between 20 and 25, and this is considered the benchmark in most industries. Then we have the high range, which is 30 and higher, where we might have high growth expectations or the firm could be overvalued. And when we are looking for a quote unquote good investment, we're typically seeking price earnings ratio in the 12 to 15 range because it typically means the firm has not really grown to its full potential yet, and we're getting in on the ground floor, so to speak. So some of the limitations of the price earnings ratio is as we mentioned before, it relies on historical earnings information and it may not reflect future performance. And again, going back to our COVID example, if you're looking at price earnings ratios based when we were in COVID, they're not going to look so great. And it doesn't consider if the firm has made recent changes to its technology. It doesn't represent any innovation that may be implemented. It doesn't represent significant market shifts. And so to correct this, many analysts use forward price earnings, forward price earnings ratios, which means they use projected earnings, and sometimes they may use trailing based on past earnings. And sometimes that's a good thing, especially during COVID, because we didn't know exactly when folks were going to come out of it. So giving them the benefit of the doubt by looking at their trailing PE was a little bit more representative for some firms. So going through this calculation process, we need two values. We need the price per share. If it's not directly stated, we need to calculate it based on our market valuation data. So the price per share is going to be the market capitalization divided by the number of shares. The second item we need is the earnings per share. And if it is not directly stated, we need to get information from the income statement as well as the market valuation data. So our earnings per share is going to be net income divided by number of shares. And I just want to raise this point because working with students, one of the items we commonly see as an error point in this calculation is some folks use revenue rather than net income. So it's really critical to remember these formulas and use the correct values. So to calculate our price earnings ratio is going to be a four-step process. The first is we have to identify or calculate our price per share. We have to calculate our net income. Then we have to calculate our earnings per share ratio, and then we finally calculate our price earnings ratio, which is the price per share divided by earnings per share. So let's go through this worked example here. So we have Prestige Worldwide, and their earnings before interest and taxes, their EBIT, during the year is $50 million. And the company incurred the following expenses during this year. So this is just an excerpt of some of their expenses that they had from their income statement. Okay, they have 20 million outstanding shares of stock with a total market capitalization of 600 million. So we want to find out what is the price earnings ratio for the company. So let's walk through it. So the first step is we have to identify or calculate the share price. Now, it's not given to us here, but we have the market capitalization information and the number of outstanding shares. So we're going to take our market capitalization divided by the total number of shares. So again, everything's in millions, so we can use this as common scale here. So we're going to take our 600 million divided by our 20 million shares, and we get a price per share of $30 per share. Okay, the next step is to calculate our net income. So in this case, we are going to use the top-down approach because we have EBIT, which is operating income, and then we can subtract our interest expenses and tax expenses. So let's grab our EBIT, which is 50, subtract out our 7 million in interest expenses, and then subtract out our taxes of 4 million. And we get 39 million. Okay, the next step is to calculate our earnings per share, which is going to be our net income divided by, our outstanding number of shares. Again, these are all scaled in millions of dollars, so we'll be able to take our earnings, which is our net income of 39 million, divided by our 20 million shares. And we get an earnings per share of $1.95 per share. Okay, the last step is to calculate our price earnings ratio. So we will take our price per share, which is 30, divided by our earnings per share, which is $1.95. That gives us a price earnings ratio of 15.39 when we round it. So this falls in the low range. So this indicates that the stock may be undervalued or underperforming from a growth perspective. And so this may represent a really good investment opportunity to get in on, quote unquote, the ground floor, because this may be a firm that's going to have high growth in the future and earn us capital gains and dividends going forward. So to summarize what we reviewed in this session, earnings-based valuation models are commonly used due to their simplicity and their relevance. The three most commonly used earnings-based valuation models are the EBIT to enterprise value ratio, the EBITDA to enterprise value ratio, and the price to earnings ratio. These models require multiple step calculations that rely on accurate financial statement and market valuation data. They are useful to compare firms within the same industry. However, cross-industry comparisons can be challenging in some cases due to varying business models and capital structures. And lastly, remember that each serves a valid purpose, but the limitations of each model must be considered to choose those that are most appropriate. If you need any support as you navigate the course, there is a series of resources available to you. Make sure you explore the D366 Connect course community and the course resources page. There's links to supplemental materials to help you navigate the primary materials that are found in the OEX platform. And you can go to the course community link on the D366 course page to access that. Make sure you are using course instructor appointments. They are the most efficient and effective way to address your content questions and receive individualized attention. What you'll want to do is visit your Meet Your Instructors section that is found on both the course community and on the course resources page. Also, make sure you check out our live event schedule. You do that by going to the Explore Cohort Offerings link on your D366 course page. And then lastly, you can always send an email to your assigned course instructor or to the team mailbox. And that is a frequent way that we communicate with our students to address questions. And we thank you for your participation in this session. Take care.